But thank you. Thanks for having me back. I was just looking back at it. This is my 4th London Investor Day for the South African client base. And I was thinking back to the first one that I did. It was actually at a competitor's office back then. It was a much smaller group. And I was there spending the first 5 minutes just explaining what AI is to everyone. Flobella's laughing. She was there. It was genuinely us going out there talking about this new technology, this new capability, and saying that there was a really good chance that this could be a very innovative way that we could employ in stock selection and equity investment. At the time, my first 3 slides were, here are the various other industries that are using it, and oh, shouldn't we be using it as well? I don't have to do that anymore. All of you know what AI is. I don't have to spend any more time talking about it. The other thing I was reminded of was when I started talking about AI, I was very technical and therefore very serious about it. And so the second time I came around, Hamilton over there said, hey, listen, can you bring a little more energy? I was like, what do you mean? It's like, yeah, you're a bit too serious. Give it horns, he said. And I had no idea what that meant. I think I have a better understanding today. So we've learned a lot over the last few years. But over that time, we've had a significant journey as well. So when we started off to now, we've developed our AI algorithms significantly. So we're on our 4th version of our AI-based investment algorithms. Over that period of time, we've developed our database significantly. So we've now, and data is really the oil that makes these engines run, these AI engines run. In our newest version, in the newest platform, we've got scale and an ability to now develop at a speed that is going to be transformational for our business. And we started with very little capital, almost no capital, a little bit of seed capital to almost running $1 billion today. But most importantly, we've invested in our team and in our people. And I'd like to talk about that. Michael over here is a testament to that investment. So yes, you got to invest in the technologies, in the infrastructure, in the data, but the IP and the people that take this forward is the most important part. And so we're very proud of the fact that we've been able to grow this entire franchise and ground up. So we'll talk a little bit about all of those things. But today's talk really, and these are the people. So when we talk about that team, there's really 5 core investment professionals associated with this product, but a massive operation. It's got the entire might of M&G's data, infrastructure, and data science teams that now span, in the 20s and 30s across the organization. And of course, the fundamental team, so our sector specialists and our fund managers who are very involved in helping us sort of make this a human plus machine endeavor. I will use, I've mentioned this before, so this is the strategy that's used in the global equity product, but we call it the Global Maxima strategy. We have a European CCAV that we run over here for our European clients. The global equity strategy is the one that we talk to you about. They're all run pari passu. So if I use the term Global Maxima, know that it's interchangeably used in the strategy that we're talking about, global equity. Okay, so today's talk is, I'm going to just talk a little bit about how we actually think about building our AI-based investment strategy. What are the key considerations that you have to have? AI is a tool in your toolkit, so where do you apply it? How do you apply it? Well, we'll go into that detail. I'll have Michael then talk to you a little bit about what those models are actually doing, give you a couple of examples, make it come to life, and then wrap up by sort of sharing some of the results, where it works, what environments it does, and doesn't. We're coming up on a 5-year track record now, so we can share some of those outcomes with you. So what problem are we trying to solve? Well, in investments, in global equities, we are trying to outperform the market. And I'd say there's really 2 ways you can do it. You can outperform global equities by allocating. You can allocate across a various set of vectors, sectors, countries, styles. Or you can say, well, I don't want to allocate within equities. I just want to pick the best stocks without taking any allocation risk. So when you talk about allocation, you can break it down. You can allocate to style. So people say, I'm a value investor, I'm a growth investor, or I can call which regime we're in. So I'm going to invest in value today because value stocks look attractive. Or conversely, I might say that actually growth stocks look attractive. And so I'm allocating in and out of value versus growth. That's a vector that you can play along, and some people do. There's the sector allocation. You can say, well, actually, tech stocks look attractive today. It's a great theme. They look cheap. I want to allocate to tech stocks and away from energy stocks. You can do that game. Or you can say, well, actually, I want to allocate to countries. I can say that, SA's stocks look attractive today. They're cheap, people cheap, unloved, whatever it is. Those are all allocation decisions. So you can allocate along those vectors, or then you can go down to selection. And you can say, well, allocation is not really the game I'm trying to play. There's a lot of stocks. I don't need to take all these other allocation risks. I just want to pick the best stocks. So when we're doing, and when we're designing our AI-based investment engines, we're using big data, large amounts of data, to understand the relationship between stocks and future share price performance. And so when we talk about big data, think of our database as being, we've got a massive database of financial statements of companies going back 30 years with all their share prices and all their underlying financials. It covers 10,000 companies. We've got about 15 million observations. That's the kind of big data you need to be able to glean information on, right? So that's massive amounts of data. You can start to learn underlying patterns that can then be used in live space in order to make predictions. But what about if you say, well, actually, I want to go to allocation? Well, those 10,000 companies in each period of time are allocated to sit in one of 10 sectors. So actually what you do is, when you start to make allocation decisions using AI stocks, you reduce your data by about 99%. The number of observations that these AI models have in order to understand the relationship between sectors and future share price performance, or countries and future share price performance, falls by about 99%. That results in shaky models and AI algorithms that are just not very happy because they want lots and lots of data. So when we say, how are we focusing our attention and ideas? We say we focus it on stock selection. Why do we do that? It's because it results in a much more stable and transferable edge that we can repeat through time. So when we design our AI-based models, we're focusing on that selection piece on the right-hand side. Now, you can always focus on one area, but you can take unintended bets on the other side. So we try to then, we're observant of what allocation bets we're taking, both on the sector, country, but also on the style side. And we try to manage those risks. So I'm going to bring Michael to come up and tell you how we're actually designing our algorithms to focus on the selection piece, give you some examples as to how these things work, and then how we correct for some of their blind spots. And then I'm going to come back at the end and then talk about how we manage some of those other risks and then wrap up. So Michael, why don't you come along?
Yeah, thank you. All right, let's see whether this clicker works. Yeah, thanks very much. So Gautam's obviously set the context of what we do at the team, but what I thought would be interesting would be to just sort of zoom out a little bit and try and give you a bit of the rationale behind why we're doing what we're doing. So the way we see it is that we're in a world where ultimately we're trying to get an informational advantage over other market participants. We're operating in a space where there's a sort of a growing vastness of data. And so we know that anything that can be measured is now being measured, and data sets are becoming available. There's a whole industry of this. And also on top of that, when we talk about this vastness of data, it isn't just in terms of terabytes of data. It's actually in terms of the spectrum of type of data. So the newer, more differentiated data that we're dealing with is less structured. And so that's where techniques like AI actually really, really help us. So in this slide, what we've done is we've sort of distilled where we think that there are some differences here. So if we just compare to maybe a more traditional fund management type approach, one is taking this set of data and applying a more of a discretionary decision-making approach to that by, using historical insights and using sort of skill in that regard. What we're doing in the AI world is we're taking all of that data, cleaning it, processing it, and allowing a model to actually train and understand those underlying relationships. And there are quite a few benefits to that, and we'll go into those in a little bit more detail, but given that we automate these types of things, it gives us that ability to really scale this out. And so to Gautam's point, we have an advantage here that we can actually do these calculations on basically any investable stock in a global universe. And also, if we calculate these on a very high cadence, we don't need to trade at a high cadence, but we can update our models on a high cadence. We basically don't have as much staleness in our evaluations of companies as if you were to just do annual updates of your models for specific companies. There's a number of other aspects of this that are also advantageous. By ultimately taking out the discretion in our investment process, we're allowing the rules-based investment decision-making to be completely unemotional. So it's a very important aspect there. We're actually, in some regards, we're playing against the market emotions in an emotionless way. So to sort of dive in, if that last slide was the why, then this is a little bit of a taster on the how. I've been told that I'm not allowed to go into too much techno waffle, but if you bear with me, hopefully we'll try and sort of keep it at a reasonably high level. Ultimately, what we do is we have a really vast historical panel of data. And we deliberately create the data as far back, looking as far backwards as possible, so that we can cover multiple market regimes. It's very important for us to have that, so that we're not training our model on a very specific type of economic environment. So that's what we would classify as our input layer. And then what we do is we allow the model actually, rather than informing the model on certain relationships, we allow the model to really build up its own intuition base using training methods. There's a lot of devil in the detail of all this, as I'm sure you can appreciate, but at a high level, it's the training exercise that really gives us that advantage, and to Gautam's point, data is absolutely everything to here. And the benefits there over, say, for example, more traditional factor approaches to investing are, rather than us impose our views on value, quality, growth, and their allocations and things like that, our model actually adapts to those. And some of the examples that we can show later will show that certain market segments have more our model picks up more sensitivity to certain characteristics. And that's a key differentiator for the type of thing that we do. So back to the slide, we have different companies, all of these characteristics that we develop for them, a number of different ways of talking about this. Some people call them features in more of a machine learning parlance, characteristics in a more of a kind of economic parlance. But that's our input layer. The model learns these relationships, and then we have the output layer, which ultimately is what we're training the model on. So that's labeled predictions. And that's what we'll talk about later in terms of the scores that are output from our model. So that's our alpha scores. And to Gautam's point earlier, again, just running some very quick numbers through this, if we have 10,000 companies active at any one point in time, we have roughly, we're just over this actually, 400 metrics that we feed into the model. And then 25 years of history, we're training this model on 5 billion plus data points. So it's quite easy to see that given the high degree of what we call dimensionality, it's a task that would be practically impossible for a human to do. And it's something that's extremely well specified for a machine learning type approach. So that obviously sounds extremely straightforward. You put lots of data into a fancy black box and it gives you some scores. It's nothing like as straightforward as that. And we're continually working on improving this process in order to sort of stay ahead of the game. So what do we need actually in practice to make this a successful operation? We need a huge amount of computer power. So since over the last couple of years, we've moved our infrastructure onto cloud-based computing. So we've had to re-architect a lot of the code base to be able to handle parallelism and a lot of the kind of computer science-based things. So that's given us a 50 times increase in compute power. We also create vast quantities of data. And this is something which is just growing, Moore's law type rates. So we've also increased our storage capacity by over 200 times. And we, as Gautam mentioned, there are 5 of us that are dedicated to this product, but we're really leaning on a lot of the expertise at M&G, whether it be the data engineering teams, the IT teams, the data science teams, implementation teams, or taking some ideas about the generation of the characteristics from the fundamental analysts. And so it's a real big exercise that we have here, and hopefully it's clear this isn't something that you can just do with an Excel sheet on a laptop. So to what the actual output looks like. So here we've just shown in a pictorial way. We consider any stock investable as something with over a $30 million market cap. We cover both developed and emerging markets. So all capitalization, EM, DM, equates to just over 10,000 stocks currently. And we calculate scores on a daily basis for this. We ingest about 4 million data points on a daily basis coming from all of the vast data sources that we get. And so when we actually collect those scores, it's those scores are ultimately our secret sauce. And we can take those scores and use them individually, but we can also build intuition about the greater market structure from that. You can look at, for example, what a sector or a geography or a sector geography pair would look like from the sort of the bottom up, what our model's telling us. Thought an example might sort of sing to you, and this is a very pertinent example because we often have discussions about this whole idea of black box, white box, transparent box. Firstly, I don't think it's a box, but at the same time, we go to great lengths to make sure that these models are ultimately intuitive. They shouldn't be doing anything too magic, too whizzy. And so we take great care in really making sure that the type of behavior that we're getting from the model is something that we actually understand from an intuitive human sense. And so a few weeks, about 6 weeks ago, I think it was, the model recommended a buy in this company, Bridge Biopharma. Personally, it wasn't a company that I was overly familiar with. That's what happens quite often in quant world. We don't have intimate familiarity with 10,000 companies, and that's part of the kind of interesting aspect of it. So when we were looking at validating this position, we said, okay, well, the price action has actually been negative for this stock, so it's actually a contrarian buy from a market perspective, negative sentiment if you're just looking at price moves. But on the chart here, you can see that our alpha score, which is on the right-hand axis here, had a big up spike. So, okay, great. Why would that be? And so what we can extract from our model is what we call SHAP values, but it's ultimately, it tells us which characteristics are the most important ones for creating that prediction. And so this is something which has been developed it comes from an academic exercise that uses a lot of game theory behind sort of theoretically backing it up. But ultimately, it tells you, and it tells us, for this company, for that score, what is actually driving it. And so it was no major surprise to us, given the industry that this company is in, that something like R&D intensity was the most influential score for it, characteristic for it. And this is, I think, a real differentiator for what we do. We haven't pre-imposed the fact that R&D intensity is an important characteristic. The model's actually learnt that. And for a company in a different sector or a different geography, the emphasis would be entirely different. And so when we were doing our validation of this, we see that R&D intensity is the most important feature. Other features are going into the evaluation, but this was the most important one. Then actually we used some of the tooling coming from the data science teams here at M&G to use GenAI, NLP-based document searches to actually understand what topics were trending for this company. And so again, this corroborates with our with our validation here. So this is a company that is undergoing clinical trials, and they're having basically they're accelerating their R&D expense in order to actually push some products to market. So we can take that even further and really drill in and ultimately drill this right the way down to the source documents, which we can see basically coming down to giving us this kind of really nuanced feature set for this given company. So hopefully that kind of gives you a flavor. This is just one example, but this is the type of exercise that we run for all of the trading that we do. And so what we actually term it is we trust the model, but we verify it. We're not applying any level of discretion, but what we're doing is we're ensuring that the model's operating in a way which is well specified. And so the machine, if you like, creates all of these scores for the recommended stocks, given the data that it knows. And that's the step one. And then that gives us our recommended trading. We actually look at that, and between Gautam, myself, the portfolio managers, we go and actually try and apply sensor checks on this to look and just see, for example, are there any data errors that have got into this score? Are there any forward-looking events that the model wouldn't have picked up on, like corporate actions or pending litigations or things of that nature? And it's edge cases, but in the edge cases, we can override the recommendation to actually buy a stock. And in some instances, it's slightly less clear, and that's where we can actually lean on the specific fundamental equity analysts to give us a lowdown on what certain idiosyncratic events would relate to for that company. And so once we've gone through those steps, ultimately we can put trades on, and that effectively takes us through the whole investment process. So I think that's my slot done. If I pass back to Gautam to hopefully tie it together.
Thanks, Michael. So we set off by saying we want to specify the areas in which we want to focus our AI-based efforts. And we laid the ground as to why focusing it on the stock selection piece is a pretty good idea. But what do you do with the other side? What do you do with the allocation stuff? What if all the good stock ideas come up in a particular country or in a particular sector? Does it actually know anything about that sector, or is it just finding ideas over there? Our contention would be that actually those are just ancillary bets, unintended bets. Indeed, we've done a lot of work to actually verify that is the case. And so what do you do with unintended bets? Well, you have to manage them. You have to understand those unintended bets, and you have to manage them well so that the piece that you're actually focusing on, the stock selection piece, can come through. So how do we do that? Well, we analyze all those unintended bets, and then we think of reasons and then test and verify reasons as to why they're unintended. And then the best way to manage them is just by constraining them. So on the country and the sector side, what we do is we put very strong parameters that allow these portfolios to only take marginal active over or under exposures. So you can see these are the active exposures versus countries on the left-hand side, the active exposures versus industry groups on the right-hand side. Those are very tight ranges of plus minus 3.5%. That's done at the portfolio construction phase. So we take optimizers, we take those alpha scores on those 10,000 companies that Michael was talking about. We then run this massive optimization that says, give us the best 100 stocks out of those 10,000 stocks, but please make sure that when you're doing that selection, you're only selecting as many US names or only allocating as much to the US as is in the benchmark. We are only allocating as much to China as is in the benchmark. Don't give me too much more, don't give me too much less. Keep that pretty narrow. And so what happens is we create a portfolio that is still targeted at those high alpha scores, but now is taking very limited bets at the country and the sector level. Now that's verified by then if you look at our active risk or our tracking error versus the benchmark and you break it down, you can see that very small contribution to that active risk will come from industry or country risk, the red and the green parts. A lot of that active risk will come from non-factor, or what we call it selection, you can call it idiosyncratic. But there's a decent chunk of risk that actually comes from style as well. Now I just said that you want to manage your style allocation. So what's going on over there? Why are we taking so much style risk? Well, you need to understand the risk and then need to understand whether that's intended or unintended. So if I break down that style risk, you can see that there's various components to it. There's value, there's growth. They're all reasonably small contributors. The big one that stands out over there is size. There's a big underweight to size, or a big small mid-cap bias within that style risk if you do a risk analysis. And actually, if you look back through time, that has been a permanent feature of this strategy. And another way of verifying it is if I go to the next slide. This is the active exposure of the strategy by various market cap buckets. So if you break down the world into buckets of, stocks that are less than $2 billion in market cap, stocks that are $2 to $10 billion in market cap, stocks that are greater than $50 billion in market cap, you can see that there's a massive underweight to these mega cap stocks over here. And that's just a function of the weight of those mega cap stocks in the index. But more sort of interesting is this overweight to mid cap stocks, $2 to $10 billion range. So why do we let that happen? Well, the proof is in, we think that inefficiencies that some of these models can get at are most prevalent in that small to mid cap range. And how do we know that? Well, this is the attribution of returns of our strategy since inception. So going back to December 2019, so the last 3.5 years, last 4 years of returns, attributed now by those market cap ranges. So most of you are familiar with attributions done by sectors or attributions done by countries. This is an attribution done by market cap bucket. And you can see that actually allocation, which is the green bars on the right-hand side, so allocating to small and mid caps has been horrible. It's detracted from performance. You know that. The mega caps have really outperformed, your Apples, your Amazons, your Nvidias have really outperformed. So mega caps being underweight that has been a pretty poor idea. But these models have been able to distinguish and find the small and mid cap stocks that have actually done really well. So the selection has more than offset the negative allocation coming from that style bet that we've taken. So what have we done over here? We said we don't really want to take allocation bets, but we're willing to, in our management process, accept allocation bets to small cap size because that's where these models are very good at working. And so when we go back to that sort of pyramid of allocation, what we're really doing is we're limiting sector and country exposures. We're accepting some style risk, specifically small cap risk, in order to get to the most efficient part of what these models can do, which is stock selection. Right, so when we go and tie it all back together then and look at the long-term performance now, we'll have a 5-year track record on this strategy on the Lux CCAP version in December of this year. So that's a reasonably large sample set. And since inception, this has outperformed the all-country world index by close to 2% per annum. It's done so in 2020, which was a year of immense volatility, but ultimately it was a growth market. Growth outperformed value in that year. It's done so in 2021, where you had a reverse of that style, where value outperformed growth. It did so in 2022, where the markets were actually down. It's a very challenging year for global equities in general. And it's managed to keep pace with the index in 2023, where the large caps really outperformed small caps, and that style active exposure was a big headwind. That headwind's carried on through this year, but ultimately the proof is in that very long-term track record that still looks very attractive. And actually, from a starting point of valuation for small caps, if you don't need that to become a tailwind, you just need that headwind to stop for this to be a very attractive starting point for this strategy going forward as well. conscious it is coming on lunch. I'm conscious Friday afternoon lunches are pretty sacred where I am. So I'll stop there. Love to take any questions. Michael's over here. All the technical ones go to him. But yeah, let's open it up.